If you ever take a studio tour out in Hollywood, you eventually walk past these massive, breathtaking Western towns or grand Victorian streets.
Oh, yeah, the backlots.
Right. And from the front, they look incredibly solid. The brickwork is immaculate. The windows gleam. The balconies look like they could hold, a dozen people. You look at it and think you could practically move in tomorrow.
But then you take 10 steps to the left.
Exactly. You look behind the facade and the illusion completely shatters. You realize it is literally just a sheet of painted plywood propped up by a couple of 2x4s and a sandbag.
Yeah, the entire structure exists exclusively to be looked at from one highly specific, highly curated angle.
Right.
If you try to actually live inside it or, lean against the walls, the whole thing comes crashing down.
And that image, that plywood facade, it just kept flashing through my mind as we were prepping for today. Because we're taking you on a brand new deep dive into a world that operates heavily on that exact same architectural principle.
The modern venture capital ecosystem.
Yes, the startup world. We're using this incredibly evocative short story by Uday Mukherjee today. It's titled Capital is a Liability, and it was published in a collection called Down in the Dirt.
It's a fascinating piece.
It really is, and reading it feels less like reading fiction and more like looking at an autopsy report of a failed unicorn startup.
Yeah, Mukherjee captures the mechanics of startup economics with this brutal level of accuracy. It serves as this perfect microcosm for how soaring paper valuations can completely detach from operational reality.
Right, creating a culture where founders optimize for the appearance of success rather than, the mechanics of a functional business.
Totally.
So we're going to extract the real-world business, financial, and psychological lessons layered throughout this narrative, because the author is really mapping out the intoxicating trap of early-stage funding and the quiet destruction of lifestyle inflation. So, okay, let's unpack this. Because the genesis of the company in the story starts off with the purest, most stereotypical Silicon Valley energy imaginable.
Oh, it hits all the classic mythological notes. You have these three highly capable friends, Peter, Andy, and Chloe, and they abandon the safety net of their corporate jobs. They lock themselves in Peter's apartment, and they just put their heads down.
The classic garage phase.
Exactly. The narrative describes them grinding for 16 to 18 hours a day, sustained entirely by ambition and caffeine, just writing the core architecture for their product.
And the product itself is genuinely compelling. Like, they aren't building some vaporware crypto token or a meaningless social media clone.
No, not at all.
Peter's vision is an admin aggregator for small to medium enterprises, SMEs. He pitches it to angel investors in the summer of 2017 in a rented conference room at a 5-star hotel. And his core hook is that they are building the Uber or Booking.com for small businesses.
Which, honestly, the underlying logic of that pitch is actually brilliant.
Right.
Think about the operational burden on a local bakery or a boutique logistics firm or a regional plumbing service. They have to manage inventory, process payroll, handle human resources, track supply chains, and maintain customer relationship management databases.
It's overwhelming.
It is. They have the exact same fundamental operational needs as a massive Fortune 500 corporation.
But the plumbing service cannot drop $2 million on an enterprise software suite from Oracle or Salesforce.
Right, the scale is totally off.
Even if they had the capital, the capacity utilization would be absurdly low. It would be like, I don't know, buying a commercial 747 aircraft just to commute to your neighborhood grocery store.
That's a great way to put it. So Peter introduces My Office. It's a localized, flexible, language-adaptable platform that operates on a pay-as-you-go model.
Oh, nice.
Yeah, so small businesses can log in and access premium tools. Advanced profit loss tracking, market trend analytics, top-tier chatbots, seamless social media integration. But they only pay a fraction of the enterprise cost.
Because they only pay for the exact compute power and services they actively use.
Exactly. It essentially democratizes enterprise-grade back-office infrastructure.
So the investors bite hard. They build the app, they launch it, and within 6 months, they secure the holy grail for a young startup. A series of funding round that slaps a $500 million valuation on the company.
$500 million.
$500 million. And this is the exact moment the plywood facade begins construction. The psychological hubris infects Peter almost instantly.
Yeah. The shift in his behavior is immediate and severe. The very first action Peter takes after the term sheet is signed is forcing his wife, Michelle, to purchase an $8,000 designer dress for a lavish victory party.
Which is just wild.
Right, and Michelle is deeply uncomfortable with this. She looks at the exorbitant price tag and explicitly tells him they cannot afford it. She tells him she doesn't need it to be happy.
But Peter completely steamrolls her. He insists she is now the CEO's wife, that all eyes will be on her, and that they need to make a statement. I have to say, reading that scene, you just want to reach through the page and shake him.
Yeah, the arrogance is palpable.
It's like running the first mile of a marathon, deciding you've basically won, and immediately buying yourself a solid gold medal to wear around your neck for the next 25 miles. You haven't crossed a finish line. You just signed up for the hardest part of the race.
That analogy perfectly isolates the cognitive distortion at play here. He is treating investment capital money given to him to execute a highly risky business plan, as if it were a massive dividend payout from a decade of profitable quarters.
Right, like he already earned it.
Exactly. And the delusion escalates. Peter immediately signs a lease to move the company out of his apartment and into a swanky, top-tier corporate tower in the heart of the city's financial district.
And Michelle tries to act as the voice of reason here, too. She points out that their target demographic is micro-businesses and local vendors. Like, a mom-and-pop auto repair shop doesn't care if their software provider operates out of a glass skyscraper.
They really don't.
But Peter's response is incredibly telling. He dismisses her completely, saying, "You won't understand. Investors want to invest in frontrunners, not laggards."
And that single sentence explains the hinge of the entire startup tragedy. The $500 million Series A creates a toxic precedent. It teaches Peter that he is rewarded for the appearance of massive scale, not the actual execution of scale.
The plywood facade.
Exactly. Soaring valuations, especially in the low-interest rate environments like we saw around 2017, were incredibly effective at masking a failing core business model.
Which accelerates us to the absolute peak of the company's delusion. They somehow managed to leverage that facade into a Series B funding round.
Unbelievable.
I know. The company reaches a $1.2 billion valuation. They officially have unicorn status. So Peter buys a sprawling bungalow. He buys a brand new Mercedes CLK. The company is throwing enormous, lavish parties where champagne flows constantly.
Yet the operational reality is quietly bleeding out behind that shiny plywood. Despite the billion-dollar valuation, downloads of the actual My Office app are sluggish.
Yeah, nobody's actually using the thing.
Right. Revenues are severely depressed. They are burning through their venture capital reserves at an alarming rate with virtually zero return on investment on their marketing spend.
I am continually hung up on the psychological blind spot here. Instead of grinding out client acquisition, instead of flying to trade shows or hosting workshops for small business owners, Peter and his co-founders are using company funds to hobnob with local celebrities at these massive parties.
It makes no sense on paper.
Right. Why do brilliant technical minds people capable of architecting complex cloud infrastructure suddenly believe that taking photos with an Instagram influencer will help them sell B2B accounting software to a regional plumbing supplier?
Well, what's fascinating here is how the incentive structures of venture capital can completely warp a founder's reality. When your company is valued at $1.2 billion, but your actual revenue is maybe $10 million, you are living in a massive valuation gap.
A huge gap.
And you cannot bridge that gap with slow, linear, organic growth. The VC ecosystem forces founders to optimize for the next funding round instead of optimizing for the end consumer.
So you were saying Peter isn't actually trying to sell the software to the plumber anymore? He's performing for the next private equity firm.
That is the core of the sickness. In the hyper-growth VC model, partying with local celebrities, driving a Mercedes, and operating out of a glass tower are not personal luxuries. They are signaling mechanisms. They are expensive peacock feathers designed to signal to the market that the momentum is unstoppable. The venture capital game often becomes about creating a flywheel of hype so you can secure a Series C round to pay for the promises you made in Series B.
But the person who actually sees the plywood buckling under the weight of this hype is Michelle.
Yes.
Peter tells his wife to stay out of his business, assuming she just doesn't understand high-level corporate strategy. But the story reveals Michelle is not just a passive spouse. She has been an accountant working in a major bank for over a decade. She is the true financial brain of that household.
Oh, she understands corporate finance on a cellular level. As she puts it in the story, she can smell cash burning. She is quietly analyzing the widening operating losses, the aimless executive travel, and the complete lack of ROI.
Meanwhile, the emotional distance between them grows. Peter only communicates through condescending text messages from his fancy office.
Which just pushes her to act.
Right. Michelle finally decides she has to step in from the shadows to save the company and her husband from themselves. She bypasses Peter entirely and secretly sets up a coffee shop meeting with Chloe, the software developer and co-founder.
And what Michelle outlines in this covert meeting is a stealth marketing masterstroke.
It really is.
It is a masterclass in exploiting structural inefficiencies. Michelle tells Chloe to immediately abandon the celebrity influencer strategy and pivot to targeting SME manufacturing and trade associations.
Real customers.
Exactly. Then she drops the real leverage. Through her banking network, she learned the Singapore government has launched a massive initiative to modernize local small businesses. The government is offering subsidies that cover almost 100% of the cost for SMEs to adopt productivity software.
Okay, wait, I need to push back on this strategy for a second.
Sure.
B2G business to government sales pipelines are notoriously brutal. Government procurement cycles usually take anywhere from 18 to 24 months. If Peter's company is burning cash rapidly and desperately needs revenue to justify their $1.2 billion valuation, how can they possibly survive the bureaucratic wait time of a government contract?
And that is the exact trap most founders fall into. Assuming BDG means selling to the government, Michelle's strategy is BDG2B.
Okay, unpack that.
They aren't trying to make the government their client. The government isn't the buyer. The government is the payer.
Oh.
Yeah, the program utilizes a panel of consultants who pre-approve software vendors. Once you are on that approved list, the SME is still the one making the choice to download and use the app, but the friction of cost is completely removed because the government reimburses them.
Oh, that is a massive distinction. So instead of fighting through a 2-year procurement cycle to get a government agency to use the software, you just have to convince one panel of consultants that your software qualifies for the subsidy.
Exactly. And we know the software itself is actually highly effective. If Peter can just get in front of that specific panel and leverage his undeniable charisma, my office becomes effectively free for every small business in the country.
Wow.
By winning over a single room of consultants, you unlock access to the entire SME market without having to spend a single dime on individual customer acquisition.
It is genuinely wild how technical founders will set millions of dollars on fire chasing flashy consumer-facing marketing while completely ignoring these boring B2G2B pipelines.
Yeah.
Like, it sounds dry, it sounds like filling out endless compliance forms, but it is a fire hose of guaranteed subsidized revenue.
And Chloe immediately recognizes the sheer power of the strategy. But there is a massive interpersonal hurdle. Peter's ego is so fragile, and he is so fundamentally dismissive of his wife, that if Chloe admits the idea came from Michelle, Peter will reject it outright just on principle.
Because it didn't come from a fellow tech bro.
Exactly.
So they have to launder the idea. Michelle instructs Chloe to fake the source. Chloe goes back to the glass tower, tells Peter she was worried about the user acquisition metrics, and claims she had a closed-door meeting with a brilliant CMO friend from another major tech firm.
A total fabrication.
Right. She pitches Michelle's exact strategy, but wraps it in the guise of high-level Silicon Valley networking.
And the Trojan horse works flawlessly. Peter's ego remains intact because he believes he is taking advice from a peer rather than his wife. He secures the meeting with the government consultants, he delivers a brilliant presentation, and the subsidy approval goes through.
And the result is explosive. They acquire more than 200,000 new small business clients in a single month.
200,000.
Verified, subsidized clients in 30 days is a monumental victory. It is the exact kind of traction they needed. But in the venture capital ecosystem, the math is completely unforgiving when it comes to timing.
Yeah, it really is.
Yeah.
The surge is phenomenal, but it materializes too late in the fiscal quarter.
The timing.
The revenue jump doesn't reflect on the profit and loss statement before the incumbent investors open the books to evaluate the impending Series C funding round.
Oh, no.
The private equity firms see the massive historical cash burn, the exorbitant executive expenses, and the deeply stagnant growth that preceded the government contract.
Which brings the entire plywood facade crashing down into reality. The investors force a down round.
Which is brutal.
For anyone who hasn't tracked the mechanics of startup financing, a down round isn't just a bruised ego or a bad PR day. The investors fundamentally reevaluate the company, slashing the paper valuation from $1.2 billion down to $800 million. Explain the mechanics of why that is so utterly devastating to a founder like Peter.
A down round is a structural bloodbath for the founders and the employees. When a venture capital firm invests at a $1.2 billion valuation during a Series B, they demand preferred stock with strict anti-dilution provisions.
Meaning they protect themselves.
Exactly. This means if the company's value drops in the future, say, to $800 million, the investors are contractually protected. The company has to issue them massive amounts of new shares to ensure their original investment holds its value.
So the investors are insulated from the drop. Who absorbs the $400 million loss?
The founders. The dilution entirely cannibalizes the common stock held by Peter, Andy, Chloe, and their early employees. Peter's personal ownership stake is decimated overnight. He goes from being a paper billionaire to owning a vastly smaller slice of a much less valuable pie. And the down round triggers mandatory structural panic.
The investor seize the wheel. The company is forced to immediately lay off 20% of its workforce. They have to break the lease on the massive glass tower and move into a cramped, cheaper office space. Every single peacock feather gets violently plucked.
He even has to sell the Mercedes.
Peter is forced to sell the Mercedes CLK, and that leads to the climax of the narrative. The hardest conversation of Peter's life. He sits down with Michelle and has to confess the reality he's been hiding. He tells her they can no longer afford the mortgage on the sprawling bungalow. He tells her they have to move.
And Michelle's reaction is incredible. She doesn't yell, she doesn't panic, she just calmly replies, "No problem, we can still move to my old place."
Just ice cold.
Peter's completely stunned. He gets defensive, asking if she was just waiting for him to fail, accusing her of never believing in him or the company.
And Michelle answers with the cold, unshakable logic of a veteran financial auditor. She tells him, "I kept it for emergency purposes. I can smell cash burning. It has nothing to do with confidence."
Peter cannot handle this mirror being held up to him. He snaps back. "Don't you think we deserve a better life? We worked for it. They invested in our app. It's our capital. It's our money."
And this is where Michelle delivers the devastating line that gives the story its title. She looks at him and says, "Of course it's your capital, but it's not your money yet. Ask any accounting student and they will tell you capital is a liability."
If we connect this to the bigger picture, this phrase fundamentally dismantles the entire Silicon Valley mythos Peter fell for. When Peter says, "it's our capital," he is treating venture funding like a lottery winning or a massive bonus check. But venture capital is essentially high-stakes venture debt.
It is fuel meant to be burned in the engine to generate momentum, but Peter siphoned it off to buy leather seats for the cabin.
That's a perfect way to phrase it. And that fuel comes with an astronomical expected return. Every dollar of that $500 million Series A and the Series B that followed is attached to a liquidation preference. It sits on the balance sheet as an immense liability.
Right.
The investors require a return that is a massive multiple of their original check before the founder is allowed to take any meaningful cash off the table. By confusing an equity obligation with personal wealth, Peter built a lifestyle entirely sustained by high-interest borrowed time.
So what does this all mean? Why did we drag you into the intricate mechanics of cap tables and B2G2B marketing strategies today? Because the central warning of Mukherjee's story transcends the tech world.
Absolutely.
Whether you are a founder running a startup, an employee evaluating a flashy new company you might want to work for, or just a person managing your own household budget, confusing available funds with earned success is a fatal cognitive trap. Just because the credit limit is high doesn't mean the wealth is real.
I think the most lingering question this story leaves us with goes far beyond Peter's individual hubris. We have to look at the machinery that enabled him. The venture capital ecosystem demands hypergrowth. It demands unicorns.
Always aiming for $1 billion.
Right. But we have to ask ourselves, is the modern VC model fundamentally designed to be a liability to genuine innovation? Think about my office. It was a fantastic product.
It really was solving a real problem.
Exactly. If Peter had raised a modest amount of money, grown organically, and aimed to build a sustainable $50 million company, he likely would have succeeded. But the venture model forced him to take on massive liabilities and fake $1 billion scale, which ultimately crushed a perfectly viable business under the weight of its own valuation. Are we structuring an economy that forces good ideas to commit suicide by demanding they become something unnatural?
That is a deeply unsettling thought to leave on. Building the perfect tool doesn't matter if the ecosystem forces you to use it as a prop. Take a hard look at the structures you are building in your own life and make sure you aren't just painting a sheet of plywood. Thanks for joining us on this deep dive. We'll see you next time.